The following are some of the worst cases of hyperinflation ever recorded in history. These currencies all became more or less worthless in a very short time, and the last one is the currency that went through the highest inflation ever recorded. So, what is inflation? Inflation is when the prices of things go up over time, meaning your money can't buy as much as it used to. It usually happens because there's more money in the economy or because it costs more to make and transport goods. One of the most well-known examples of hyperinflation is the German inflation in the 1920s. Germany was on the losing side in World War I, and the countries who were on the winning side, the Allied powers, forced Germany to pay them huge reparations. Germany had funded the war entirely by borrowing money instead of implementing new taxes, which might have angered the public. So Germany was in a very bad position and couldn't afford to pay the war reparations. Germany also had to pay in foreign currency, not in its own currency, the mark. To get that foreign currency, Germany kept printing more marks, converting them to buy foreign money. This created a vicious cycle. More printing led to a weaker currency, which led to higher prices to buy foreign currency, which led to even more printing. The Allied powers were dissatisfied that Germany did not pay the reparations quickly enough, and in 1923, French and Belgian troops were sent across the border to occupy the Ruhr Valley, Germany's main industrial region. Germany naturally didn't like this, and the workers in the Ruhr Valley were called on to go on strike, with the government printing tons of money to support them. By now, the currency was in free fall, and people really lost faith in the German mark. A loaf of bread in Berlin that cost around 160 marks at the end of 1922 cost 200 billion marks by late 1923. Prices were doubling every few days, and people started using money as wallpaper and firewood. People would need baskets and sometimes even wheelbarrows to pay for their groceries. There are even stories of thieves dumping the money on the ground and stealing just the basket or the wheelbarrow. A lot of people believe that Germany's hyperinflation started simply because too much money was printed, but that's only part of the story. Many historians say that the German disaster wasn't just caused by the size of the reparations, it was the uncertainty surrounding them. The Allied powers, especially France, Britain, and the US, couldn't agree on how much Germany should pay each year. France demanded fast, heavy payments, while the others hesitated. As a result, the German government never knew how much it owed, which made it impossible to plan a national budget. That constant uncertainty created panic about Germany's financial stability, and if there's one thing markets hate, it's uncertainty. This led to international investors fleeing Germany and caused the German mark to collapse even faster. Today, the German hyperinflation in the 1920s remains as one of history's clearest examples of what happens when trust in money disappears. Another, more recent example of hyperinflation is the case of Venezuela, which had its peak in 2018 but is still ongoing. Venezuela's economy has long been overly dependent on oil exports, which naturally also makes it overly dependent on oil prices. So when global oil prices dropped around 2014, the government's income collapsed, without economic diversification to cushion the blow. But rather than cut spending, the government continued financing public programs, leading to massive budget deficits. To cover the deficits, the government, and especially the central bank, printed large amounts of money, and without enough goods or services to match the large increase in currency supply, inflation soared rapidly. In an attempt to keep basic goods affordable, the government imposed strict price controls. This backfired, with production becoming unprofitable, leading to severe shortages of basic goods. The government has also taken control of many private businesses and industries, which has led to these companies often becoming less efficient. Without competition or profit incentives, they produced less and sometimes mismanaged resources. As a result, Venezuela couldn't produce enough goods on its own, so it had to import food, medicine, and other basics from other countries. But because the economy was weak and the country had less money, it couldn't afford those imports, which made shortages even worse. In late 2016, Venezuela entered a period of hyperinflation, with inflation rising by several 100%. In 2017, it was even worse, with the inflation rate reaching several thousand%. And it peaked in 2018, but it was hard for me to find the exact number because, as this Wikipedia article says, in early 2018, the Venezuelan government essentially stopped producing inflation estimates. The same article also describes how some shops stopped using price tags altogether as prices rose so quickly that customers had to ask staff for the current price of each item. The inflation, although still high, has slowed somewhat in recent years. The hyperinflation crisis has led to massive poverty, and millions of people have left Venezuela since the crisis began. Because of the major unreliability of the Venezuelan bolivar, many people and businesses have started using US dollars instead. Another hyperinflation crisis that most people probably have heard of is the Zimbabwe hyperinflation crisis in the 2000s. This crisis is listed as having the second highest monthly inflation rate in history, and it resulted in Zimbabwe abandoning its local currency, the Zimbabwe dollar. When Zimbabwe became independent in 1980, one Zimbabwe dollar was worth more than one US dollar, but that conversion rate was about to change drastically. But first, a bit of history. Zimbabwe used to be a British colony called Southern Rhodesia. In the late 1800s and early 1900s, many British settlers moved there. They took over large areas of land and built farms, businesses, and infrastructure. For decades, a small white minority controlled much of the country's economy and government. When Zimbabwe became independent, white farmers still owned a lot of land. The Zimbabwean government, led by President Robert Mugabe, began taking land from white-owned commercial farms and redistributing it. And most of the time, the people who received the farms were members of Mugabe's political party rather than individuals with actual farming experience. As a result, food production collapsed and the country had to rely on expensive imports. At the same time, the government kept printing more and more money to pay off debts and fund public spending. But printing money without real economic growth made the situation worse. Prices started rising out of control. By 2008, Zimbabwe's inflation reached truly unbelievable levels, and at its peak in November of 2008, it took only 24 hours for the prices to double. The Reserve Bank of Zimbabwe responded to the rapidly decreasing value of the Zimbabwe dollar by issuing larger and larger bills, including the infamous 100 trillion bill. In other words, the number 1 followed by 14 zeros. In 2009, Zimbabwe gave up and allowed people to use foreign currencies like the US dollar instead. And that is when the hyperinflation finally stopped. The last hyperinflation crisis is the most extreme, with prices doubling every 15 hours during the worst month. The Hungarian penge suffered the highest rate of hyperinflation ever recorded in human history in the aftermath of World War II. Factories were destroyed, farmland had been damaged, and the people were struggling to survive. To make things worse, Hungary had to pay heavy war reparations to the Soviet Union, similar to the reparations Germany had to pay after World War I. To try to deal with this, the Hungarian government printed an obscene amount of money. But without enough goods and services to back it up, that money quickly lost value. Prices began to rise so fast that people's life savings were wiped out in a matter of days. To keep up with the skyrocketing prices, the government introduced new versions of the penge. First came the mil penge, meaning 1 million penge, and shortly after that the billion penge. These new denominations were an attempt to simplify everyday transactions, but they reflected just how extreme the inflation had become. The penge became so worthless that Hungary eventually had to introduce a new currency, the forint, in August 1946, which the country still uses today. On the 1st of August 1946, Hungary introduced the forint at a ratio of 400 octillion penges to 1 forint. In other words, the number 4 followed by 29 zeros.